The Bharat-22 ETF, remember, it has been launched today. That's the second tranche, of course, for fresh subscription. It's going to be open between the 20th to the 22nd of June for retail investors, and for anchor investors, it's going to be open today on the 19th of June. Just a quick refresher for our viewers. Do remember that the government had essentially launched the Bharat-22 ETF, or Exchange Traded Fund, which was managed by ICICI Prudential Mutual Fund back in November 2017, which essentially was a vehicle for the government to go ahead with its divestment program. So if you look at the constituents of Bharat-22 ETF, it's the usual, divestment participants. So it's all of the OMC companies, it's an ONGC, REC, PFC, ITC, Axis Bank. These are the guys that have found themselves in the ETF. So let's discuss whether you, the retail investor, our viewers, should essentially put their money into Bharat-22 because, well, face it, it's essentially comprising the jewels of India Inc., and that too at a 2.5% discount. So let's bring on board Dhirendra Kumar, the CEO of Value Research, to talk about this. Dhirendra, hi, good afternoon. Thanks for joining in. Very classy set of stocks, elegantly placed, interesting representation from various sectors in Bharat-22 ETF. But if we look at how the first tranche had been subscribed, it was a good subscription, But up until now, the performance has been just about okay-ish. So what exactly would be your recommendation? It is available at a 2.5% discount. So what's your first call? Is this a good option for retail investors?
It's an interesting option. It might prove to be a reasonably attractive thing for investors. It is a better option than it's just not a PSU investment disinvestment vehicle only in a way, because if you look at other rounds of disinvestment or the other alternatives, previous alternatives, compared to that, this is nearly 40% public-private sector companies. L&T, ITC and Axis Bank, they together account for nearly 40% of the total fund. So this is 40% non-PSU. Generally speaking, I'm wary of PSUs. Government being the owner of companies itself is a bad news. But the set of PSUs, which I find here, except for all marketing companies, they are quite varied, though they're small stake. When I look at NBCC, when I look at Bharat Electronics, I don't find them to have those variables of PSUs, but they are definitely companies with significant competitive advantage. They have moat around themselves. They are unique business model. Of course, being a government-owned company in a capitalist world itself is a bad thought. We know that of the 250 public sector companies, these are the only 40 companies survive and thrive, or they have some advantages. But when I look at Ingenious India, when I look at Bharat Electronics, even the power companies, the NHPC, so I find that this is a great fund. There isn't a great novelty in this. All these stocks can be bought. I like the low expense of this fund. This is 0.01%, which is virtually nothing. Yeah, so it is available in a neat package. 2.5% discount also makes it attractive. Relatively superior quality of PSUs and 40% private companies, which are relatively out of favor. That is why it has not done well since the issue of the first tranche. So I think it might be an attractive ETF to have. For how long, I don't know. But if any investor is not thinking for 2-3 years, one should not have a short-term view on such a fund.
Hi Dhirendra, it's Nayan from the New Delhi newsroom. Incidentally, we will also be doing a Facebook Live with Dhirendra Kumar at 2:30 p.m. Discussing Bharat-22 ETF. So Dhirendra, from what I'm understanding, your recommendation seems to be, yes, it may be a good time to put your money into Bharat-22. You don't seem to be too perturbed that there is a weightage on the banks, and banks are not the flavor of the season right now, neither are the energy companies.
Yes, despite that, if you look at the decline in the value of their large companies, good number of companies here have significant competitive advantage. But when I see, Larsen & Toubro and ITC accounting for nearly 31% of the fund. So one third of the fund is an Axis Bank, another 8.7%. So this fund is, this was actually devised as a vehicle for the government to get, to sell off the holdings that they have. but the package they have been able to create is nice. The banking dominance actually comes only from this Axis Bank and State Bank, which I would still say that it might be the best of the lot, which the government has to offer. Remaining stuff, is virtually insignificant. Bank of Baroda is just 1.15% of the fund. The rest of the companies, public sector companies, are quite prominent one, and they have the competitive advantage. Some of them might be very cheap as well, and they are leaders in their segment. So, of course, public sector comes with a rider that they need to really can they withstand the pressures of competitive pressure of the economy. Some companies have been able to prove their mettle. They have some advantages, cost advantages. For example, NTPC, the fifth largest holding of this fund, which accounts for nearly 7.7%, is a very interesting, Power Grid, which is a non-replicable business. The sector has been opened up, but I don't think, this company can lose its moat for next 20 years.
Dhirendra, my other concern is about how this ETF may be conspicuous of a lack of a clear strategy. You mentioned about how expense ratio is just about 1 BIP. That's perhaps because of the fact that neither is it an actively managed fund, and nor is it essentially tracking any benchmark which has specific characteristics. It's just, if you look at it plainly, it's randomly selected stocks that the government wants to divest of, and it wouldn't be proper to perhaps call it as tracking India's growth story, because then it lacks the likes of an RIL, it lacks the likes of an HDFC Bank or even an HUL for that matter. So for retail investors, this lack of a strategy, wouldn't that be a worrisome factor? And wouldn't that be a reason why they perhaps would go for any other mutual fund as opposed to this ETF?
Yes, there is an absence of strategy. But I find that, the starting point of this fund was not that, the government wanted to create a great vehicle for individual investors. They wanted to create a vehicle for individual investors whereby they should be able to sell the stock holdings of many companies that they are owners of. So the starting point is very straightforward. Government wants to sell its stock ownership of the companies which it has accidentally or somehow strategically did end up owning. So that's the starting point. I think actively managed fund might be a better option. But when I look at this complexion, it is not all that bad. When I look at, the kind of companies, from relative valuation point of view, how this portfolio has been, if the constraint was that government wants to sell, I think this is one of a very novel package which has been created. 2.5% should not be should not be the only reason why investors should come for a short while. But I think the kind of companies, their relative valuation, many of these companies have been out of favor for a long time, and some of these companies might have a great investment case. So that should be the investment case. Absence of an active management. But when I look at the expense, an active management must must deliver 2% more to match the return of this fund. That itself translates into a competitive advantage.
Our final question to you before we let you go. I did meet with senior officials of the Finance Ministry yesterday, and they did say another reason for retail investors and to really open this up for retail investors for the first time round, a non-demat account holder through a fund of fund can actually invest in Bharat-22 ETF. Is that correct? And do you think that could then, maybe rewrite the rules of the game and really help in penetration?
Yes, I think so, because we have seen it in many situations. Because mutual fund industry, it's one of its advantage has been that they are able to approach investors through their distribution channel in a manner which is not necessarily dependent on the stockbrokers or the demat account. And here is a fund which was which necessarily required a demat account for an investor. So this way, your ability to hold this ETF without having a demat account will democratize this investment more, and it might still be of appeal to many investors. It may not be the finest actively managed choice, but going by the complexion, the way it has been packaged, it looks reasonably attractive.
Okay, Dhirendra, thanks so much for joining us here. Should you put your money into Bharat-22 ETF? It's a yes from Dhirendra Kumar.